Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, US stocks managing to finish in the green on Friday after early weakness from the fact that European banks were coming under pressure as their credit spreads were blowing out, particularly Deutsche Bank, as that 81 bond market came under pressure. Obviously, Credit Suisse 81 bonds getting wiped out on that bail-in from UBS and the Swiss government. Gold did reverse lower as well, popped its head above 2,000 briefly, but that's third time was not a charm, and it came back down again, and it's a little bit softer again today. And then the other commodities also paused a bit. They had a decent week in general, but the likes of copper pulling back 1% after rallying about 5% on the week. Nat gas and uranium, though, still remaining weak on a relative basis. If we look over at vols, we can see US vols did come down about a point, down a fair amount on the week. So we've got about 2 to 3 vol points on Nasdaq, Russell, and S&P. Europe, on the other hand, had a 3 vol pop on Friday. They are down on the week as well, but obviously recovering there with those banks coming under pressure and people getting a bit spooked again. Now, European vols are above S&P vols. You've got Euro stocks here at 21, S&P 19.5, but that spread is winging around a bit. But at the moment, Europe's holding the premium. Commodity vols down. They were mixed on Friday, but you saw generally 2.5 vols lower in gold, silver and oil down, copper slightly drifting. The only vol really up on the week was natural gas. You can see in carry, we've got deep negative still for Europe as it continues to move around way more than its implied vol, whereas your main positive carry is coming from the likes of China. In commodities, we saw negative carry still in gold and copper, so they're your best movers. Everything else in the green, with the likes of uranium probably giving you the best juice if you're a theta earner right now. Although implied vols are pretty low in uranium from a percentile basis, so I'm not personally going out there and selling any uranium gamma. If we look at SKU did rebound in Europe there, looking pretty expensive on an 8 handle. But you see the percentile ranks 60 to 80 percentile across all the major index SKUs, pretty much showing you that there's quite a lot of negative sentiment now priced into the option market. If we look over at precious metals, they did bounce. SKU was up by about a point in silver and gold, but it does still reside in cool territory, and those percentiles are quite low. So clearly, the options market on the pricing in that upside tail in precious metals is still the thing to own. And then if we look at energy, all those SKUs are still parked in the 90th percentiles, which is kind of on the flip side where people are more worried about energy breaking down as a recession may start to materialize at some point this year. All right, moving on. Sentiment really getting crushed as focus shifts to commercial real estate. So this is a story really doing the rounds at the moment. Since the regional banks have been having a tough time, people are now focusing on their exposure to commercial real estate, pointing out that the notional in commercial real estate debt maturities over the next few years is in the trillions, 2.5 trillion over the next 5 years to be exact, and 400 billion due just this year. And these are going to be hard to refinance these loans. Okay, so if you look at the office sector as well, and you look at what REITs have been doing over the last month, the office REITs getting clobbered nearly 30% versus regular REIT index down 13%. So really the office space getting hurt by the fact that work from home, the shift of work from home after COVID has really made a lot of these office buildings non-viable, and they haven't been able to fill them. Okay, so that seems to be what's going on there. And people are concerned. US regional banks account for about 65% of all commercial real estate lending. And so, the inevitable tightening in lending standards is going to have a huge economy-wide consequences over the next few years. So this is really the thing that's kind of the next shoe to drop, as it were. The question is, how quickly does it drop? Clearly, the REITs are getting smashed. But when are we going to see the defaults and all this stuff? We don't know. But in general, this is the cloud that's hanging over the economy and the market for some time, I would think. Now, despite all that stuff, obviously these structural issues are a massive headwind, but sentiment in markets has obviously turned very sour. And you can see this in the Goldman Sachs sentiment indicator has gone back down to extremely light positioning, extremely bearish sentiment. So in the absence of an immediate collapse and an immediate problem within that sector, we do think there may be a near-term relief rally in markets just in general. Now, the open question is, the markets have obviously liked, or certainly the tech stocks have liked the idea about Fed pivot. But what do you do? Do you buy or sell the last Fed hike, right? In terms of our muscle memory and what we're used to, is like, okay, well, if the Fed's pivoting, then that must mean buy risk assets, right? If you go back to the 70s or 80s, as Michael Hartnett points out, the playbook that actually worked in the more inflationary period was to sell risk assets, sell equities on the Fed's last hike. So we'll see if that's how it materializes, but that is different to what we've kind of been trained to do over the last decade or so, or even more. But that is one potential thing that has worked historically. So whilst we may get a squeeze in the near term, that last hike, whichever one maybe we get one more potentially in May, there's a chance that might be your opportunity to sell in May and go away, as often is the case. Okay, now where's this rally going to come from if we do get one? Well, clearly the tech stocks have been the beneficiaries of the recent banking crisis. Shifting interest rate expectations has helped those. Nasdaq's once again threatening to break this key 13K level. So it's been in this box for a while, trying to take this thing out again. If it goes, no reason why 14 is not your first stop. And if that goes, then who knows, right? Then we're talking about 16 at some point. But I don't think that's necessarily going to happen. But certainly a break of 13 is potentially on the cards and will trigger more short covering. Positioning wise, if you look at mutual funds, they've been underweight these big cap techs for a long time. They've started to address them, but they've got a hell of a long way to go, nearly 600 basis points underweight still. You look at hedge fund positioning in these big names as well. It has moved back towards a 5-year sort of average type level, but it's certainly got room before it gets to a stretched percentage in terms of their exposure to these names. So lots of potential chasing still to be done. And then if we look at volatility, upside volatility on NASDAQ, that's this green line here on the 14,000 and above. That stuff's priced pretty cheaply at around 20 vol. And if you look at all of the observations, which are all of these dots here, none of them have been anywhere near 20 vol for months now. So the idea being that if we were to get an upside chase in the NASDAQ, that upside vol looks quite good value, which means call options in NASDAQ may be an interesting play. Okay. Clearly there's a big disconnect between the market and the Fed rate projections right now from what we saw in FOMC last week. So maybe that's holding some people back from going all in on the tech trade, because even though the market's saying we're getting a pivot, the Fed's kind of saying we're not yet. So maybe when the Fed does and actually admit that they're done with the hiking cycle, maybe that's your next leg higher in tech. Okay. And that might happen over the next couple of months. Right. So if we do like the idea that NASDAQ has the potential to break higher, what do we do? Because looking at our strategy compass, it's telling us to buy puts, right? Because the mean reversion trade is saying, well, spots up here at the top of the range again, vol's looking quite good value. Surely you want to buy puts to play the mean reversion. Now, whilst that often isn't a bad trade, and that may still be the right thing to do now, my rather than playing that mean reversion in tech, I'm more looking at the idea that tech might break out and go a lot higher, given the fact that the macro picture is kind of changing a little bit. Okay, so that's my thought. Now, you don't necessarily want to pile into a load of delta right now, given you are at these local highs. But what you probably do want is something a bit more explosive to the upside. Like if you were to get the break, then you want some upside volatility to kick in and give you some exposure, right? So how do you achieve something that's not too delta long, but does well from a violent break higher? Well, that's where you could do call ratio back spreads, where you sell calls and you buy multiple calls above that, and you get that gearing to a real explosive move. Now, the nice thing about that as well is that the skew is pretty steep. Okay. Actually, so you can do call ratio back spreads. That's one way of doing it. But another way of doing it is actually selling puts to buy calls. And that's where the skew comes in, because we've got 1 month skew at 7 vols still, which is in pretty high percentiles. So even though tech has been rallying and everything else has been a bit weaker, the tech put skew has still caught a bid in sympathy with all the skew going bid. So for us, that feels a little bit mispriced, that they're not really reflecting the risk that tech could scream higher because of what has happened in the rates market. And if that gets confirmed, then that may be your opportunity. All right, that's the trade idea for today. Thanks a lot, as always, for listening. I'll catch you guys tomorrow. Cheers.